Hi there, welcome to Build Your Wealth. I am your host Linda. Today I am here to comment about the Kenya Pipeline Company initial public offer. I'm sure you've heard of this because it's been going rounds, and let me give my 2 cents concerning this. Initial public offer is when a company issues shares through the Nairobi Stock Exchange for the very first time. This is when a company has been previously owned privately or wholly by the government. In this case, the Kenya Pipeline Company had been fully owned by the government, but now the government has issued 65% of its shares to the mwananchi and investors. And the details of this initial public offer is that one share is going at 9 shillings. This was offered from the 19th of January 2026 and it's going on up to the 19th of February 2026. After that, it will be closed and then it will be listed again in the Nairobi Stock Exchange on 9th of March 2026. Details of these shares is interesting because it will help us to make informed decisions as investors. So as we have said, each share goes for 9 shillings. The total number of shares that are being issued are 11.8 billion, but the 100% now, all the shares that the company is worth, the holdings are about 18 billion. So that 11.8 is the 65% of the shares. The government is keeping the remaining 35% of the company. You may ask, why do the government issue initial public offers? It is to raise money for expansions, to pay debts, and to grow operations. For Kenya Pipeline Company, let's look at last year's revenue. They were at 38.5 billion and the profit after tax was around 7.49 billion. Interesting. How do we know if the 9 shillings per share is highly valued, fairly valued, or undervalued as investors? Let us use price earning ratio to determine this. We have the details of the company from its revenue and profit after tax from last year, 2025 financial year. Price earning ratio will show us how much an investor is willing to pay for every 1 shilling of profit from the company. And PE ratio is calculated by doing market price of the share divided by earning per share. We know that market price of the share is 9 shillings. Let's now find out the earning per share. Earning per share, we will find it by doing profit after tax of the previous year divided by the total number of the shares held by this Kenya Pipeline Company. So that will be 7.49 billion around there for the profit after tax from last year, divided by, remember we said it has 18 billion shares. If you divide that, you will find a figure like 0.41. Now we come back to our PE ratio where we will do a market price of the share, which is 9 shillings, divided by earning per share, which we have found at 0.41. I hope it's clear. So the figure will be 21 point something, which is about 22. That means that as an investor, you're willing to pay 22 shillings for every 1 shilling profit from Kenya Pipeline Company. Yeah. So for this valuation, which is price earning ratio, it is best if we use it to compare companies which are in the same market and in a similar industry. Which other companies are in this industry, like the energy industry? We all know what Kenya Pipeline Company do. They transport oil from the ports into, the country and all that. So if we compare it to a company like Kengen and maybe KPLC or even Total, Kengen has a price earning ratio of about 6. Is it 6 or 9? KPLC's is around 1.2. This means the 22 from Kenya Pipeline Company shows us two things. It could either be investors are expecting a higher future growth of this company, or the price of the share is overvalued, which is the 9 shillings. Since there are two sides of the coins and we do not know which one is correct, whether it is overvalued or whether the company has potential for future growth and it is a good idea to buy the shares on IPO, it is really a personal decision to make at this point. This will depend on you as an investor, your risk appetite. If you have a risk appetite and you are a long-term investor, this could be a good idea to try it out. If your appetite is low, you are not a risk taker, if this will make you lose your sleep, I would advise that maybe don't give it a chance. What I would say is, before you buy the initial public offer, don't just follow hype. Try to check the company's profits, read their prospectus, check their valuation, check their growth potential, and whether the price makes sense. Also, let me know in the comment section if you have bought these, and if you haven't, tell us why. And if you are keen on these shares, you have about a week before they are closed. If you want to buy them, go to the Kenya Pipeline Company website. It is just straightforward, I promise. But if you have any problem, you can just inbox and I'll be willing to help. Other than that, I wish you a happy investing and enjoy building wealth. Bye.